in. Please post your questions using the control panel on the right-hand side of your screen. The question box appears towards the bottom. So, over to you, Bruce.
Good morning or good afternoon to all attendees. Thank you very much for turning up to listen to our views on what's happening in the IT M&A market. As a starting point, just for those of you who are not up to date with us, I would briefly like to explain who Equiteq are and what we do. We are a pure M&A advisory business only in the consulting sector, and when we say consulting, it obviously includes IT consulting services, which is what I imagine many of you are today, but obviously broader management consulting, media type companies, HR, engineering. Basically anyone who's selling their knowledge at a premium price rather than selling the value of their balance sheet or the P&L is a type of company that we work with throughout the world. We're about 50 people based out of London with a New York office, also extending in Singapore and Sydney. We are a single entity. We're not just a loose network of partners who claim to have a global coverage, but in reality are just individuals working in their own particular neck of the woods. And we've done about 40 deals so far and worked with about 300 clients in the 10, 12 years since we've been founded. I think it is important to look at these things internationally. An illustration of the degree to which transactions take across borders is that a few weeks ago we had an Argentinian working for out of our London office who sold a Brazilian business owned by a Spanish company to a German buyer, which is indicative of the degree to which cross-border deals take place. So that's who we are and what we do. What we produce as part of our understanding and knowledge of the IT market and M&A market is an annual M&A report. Many of you will have seen links to this on our website or on emails introducing you to this event. If you haven't got it, please follow the link and download. It covers all consulting sectors, but what we're going to do today is dive down specifically into the IT sector of the market. So the first key point, if we look at the overall market, is that deal volumes are up. They're actually up nearly 10% in 2015 over 2014, and they're now up above the heady days of 2007 when there were in the sector over 2,400 deals. The graph on the top right is showing moving average of monthly deals, and then we've got annual summaries down below. And it clearly shows a reflection of the economic woes many of us have worked through, the boom times at the back end of 2007 and 8, the financial crisis, and then the recovery since then. And while there was a slight downward turn in 2013, volumes have stayed high and continue to grow. When we started hearing about a lot of the news about M&A volumes in general and big layoffs of some of the big investment banks, there may well be a Q1 downturn in value of deals done and less mega deals. But in fact, in terms of a volume of deals in the consulting market, if we rolled this data forward into the first 3 or 4 months of this year, we would see volumes holding up and being ahead of last year. So general message there is volumes are still holding up, and buyers are still buying, and there is interest from buyers of consulting business. As we take out our clients to prospective buyers, we see no shortage of interest. And I think so far this year, I've only had one buyer say we've put deals on hold. So the buyers the wallets are open, and they're certainly out there buying. So that's the overall market. If we zoom down now into the sections of this area, the IT consulting, that dark blue segment to the top left, represents over a quarter of the market. So 28% of that 2,500 deals are within the IT consulting market, and we'll dive into that at this moment in time. So in terms of number of deals, IT, we saw a 3.1% growth from the previous year, up to 690 deals last year compared to 669 the previous year. So not quite as much as some other sectors, but nevertheless a positive growth in the market. So that's the increase in deal volumes there for consulting just alone, and IT demand was very high in North America, so 272 up to 365 deals. So that's where most of the growth has come from. Perhaps a little stagnation in Europe and elsewhere in the world, but the US is the driving force behind the growth in deals for IT services. In terms of values, the two key figures to look at are revenue multiples and EBITDA multiples over time and for the sector. And I'm going to refer to some of these again as we go through this section, but it really is important to look at both these numbers with a degree of understanding. First of all, on revenue multiples, it is very rare, not exclusive, but very rare for a company to actually be valued according to its revenue multiple. More often than not, the revenue multiple is a figure that's used as a relative valuation consideration rather than a base on which a price is quoted to a potential buyer. Most acquisitions and purchase price are based around some kind of EBITDA calculation, whether it's a multiple, whether it's forward, backwards, NPV, lots of different methods, but the EBITDA will be the overriding driver of the value of the business. And clearly, when we see multiples being quoted, and here we're talking about the 215 and even the 5-year median values being at around 8 times EBITDA, it must be remembered that these are derived figures based on historical numbers. So it's taking the value of your business at the point of sale and dividing by the EBITDA in the prior complete year. Particularly if a business is growing quite significantly, that's going to be much lower than the current year value on which the deal was calculated. So yes, average EBITDA multiples are 8. That does not mean that the average IT consulting business is going to sell for 8 times current year profit. So that's just a warning as we go through these figures. However, overall we can see in the trend that maybe it's slightly downwards, but it's certainly holding up very well over the past few years. We've looked in and dived down to a little detail, try and see what are the overall IT consulting, which is up 3.1%, what parts are of interest. And it's possible when looking at all the deals to pick up attributes associated with deals, and some of the big words around that buyers are talking to us about and looking for companies within this sector are things to do with social, things to do with mobile, things to do with analytics, and things to do with cloud. So if we look at the number of deals that have this attribute and index them back to 100 for 2010, we can see that all of these are up. Social may be down a bit in 14 and 15, but the whole cloud requirement is very much an upward trend, and anything that links to that, cloud, digital transformation, and if it has a link to customer interface, well, we can't actually pick up those latter terms easily in the deal data. Those are things we know that our buyers are looking for. So cloud certainly was the hot element over the last few years, and we have no reason as it moves into digital transformation why that shouldn't carry on into the future. And in terms of the buyers, it's actually well, there's a very large number of buyers out there who do buy companies. Lots of them have bought 1 or 2 companies in the last 5 years. In terms of the regular buyers, it is the large IT services companies and the big 4 consulting businesses are by far and away the most prolific buyers of IT companies. And no surprising, Accenture up there at the top of the list, very keen on companies that have strong levels of IP that they can leverage around the globe, as well as things that fit in with a very clear sector focus and fit within their organisation as they move forward. All of these buyers seen down here, Accenture, Ernst & Young, will be very interested in looking at most opportunities that are presented to them. That's the buyers. Let's now dive down into some of the subsectors as best we can define them for the IT servicing world. Let's talk first about IT outsourcing type businesses. Here we see a downturn in transaction volumes, not a lot of deals, down at 58 or something like that, and a downward trend. So it's not a hot sector by any means. And in terms of yields, the key one there is the 2005 line. Average revenue multiples of just over 1, and median EBITDA multiples around about 6.6. So not a lot of volume, and certainly not premium pricing at this moment in time, certainly lower than they have been in the past. And the reason for that is most of the deals that we see are taking place are buyers who are looking to scale their business by acquiring targets with similar capabilities. Whenever you get to an acquisition point where somebody's buying more of the same, you will never get, or unlikely, I would like to say never, you are unlikely to get to a premium price, because they're just adding you in. What you really need to be looking for is where you bring something new and scalable to the potential acquirer. So for outsourcing business, it's more of the same, people bulking up, taking a stronger position within a certain sector, and driving their business out from there. Look in terms of big data. No surprises. There's a general upward trend in volumes over the last 5 years. Total deals done, perhaps plateauing in 2015. Slight issue here sometimes in trying to pull together a clear definition of what falls into this area. There was a lot more BI type transactions in the past. They've fallen away, and it's definitely the big data and the level of very sector-focused analytics tends to pull through demand. But certainly they get, in the sector, there have been high revenue and EBITDA multiples, 1.8 in terms of revenue multiples and 23 or so for EBITDA. Again, just linking back to the previous comments about multiples here, they are based on historical figures, and strong growth will always put you up a high level in terms of the multiples being reported, and profitability, particularly if people have been investing in developing IP, then that will be a cost that gets adjusted out. So the valuation will be on a higher profit than being reported. There will be the figures shown here. But all in all, big data continues to be something that's highly sought after, and lots of people are interested in that. It can be a high value-add service to a broad range of different buying communities, all of whom looking to add that capability into their organization. And when looking for a buyer of that sort of service, the big data analytics, one has to really stretch the buyer group search wide to find out who are the guys to whom your service will be able to provide most leverage, rather than just how can we be more of the same to existing BI and analytics type providers. Stepping forward to cyber security, obviously big news everywhere, and we continue to see volumes growing there, up by 43% over the last year. So strong demand, particularly in the US, but again in Europe and the rest of the world, again heading in the right direction. And in terms of valuations, we're seeing median revenue multiples of 2, EBITDA multiples of 12.6. Yes, that's half of the previous, on the EBITDA multiple for the previous group we looked at, the data analytics, but a little bit of caution when looking at these figures specifically because of this poor low profit presentation in published accounts. A lot of large corporates looking to buy into this area. Most IT services companies are making sure that they have a very good cyber offering within their offering and to provide suppliers. So no shortage of people looking to develop that capability and acquire the medium and small size cybersecurity businesses. Cloud consulting, anything to do with taking people out into the cloud. Steady growth over the last few years. Yes, slight plateauing perhaps in the US and Europe, but the trend is still strong there and plenty of transactions taking place. A very significant proportion of all transactions in this sector. And the multiples, surprisingly, maybe the revenue multiple we're showing here at 1.1, EBITDA 11.3, lower than I would have expected. Perhaps some further delving into that might be required to fully understand exactly why that's the case, but certainly strong demand, particularly if you can add in anything to do with the customer interface into the cloud migration, so pick up all those Salesforce type deals and similar type of transactions. And again, IT consulting, and the media firms particularly, picking up that point about Salesforce, anything that takes cloud to the customer interface suddenly introduces all the big four media companies, Omnicom, WPP, Publicis, who are very interested in extending their IT capabilities to facilitate all their marketing and media type activity. And generally speaking, that is the most interesting buyer group for anyone with an IT consulting offering, and will certainly want to see to what extent their attributes may be able to find a way to meet the requirements of that particular buyer group. And finally, the enterprise applications. Primarily, we're talking about the people here who are implementing SAP, Oracle, Microsoft Dynamics applications. This was a big market, and it has actually been slowly declining. It's certainly not the hot area anymore, and we've seen a steady decline in desire to pick people up in this particular space. Though that's not to say we don't get interest from particular buyers for companies, but they're not normally interested in the core application implementation. So they would be interested in the implementation of new, for example, SAP add-ons in things like SuccessFactors, which might pick up in the cloud, but core SAP implementation is not under high demand. There have been a few big deals, so for example, a few years back, Infosys buying Lodestone, but generally speaking, just core ERP is not strong in the market. If we were to look at which products are of interest, the key ones here, Microsoft, SAP and Oracle, still lots of SAP deals going on, that number has held up. The amount of interest in Oracle greatly reduced. That is down quite significantly, nearly halved in 2015. Microsoft numbers do dominate here, but I would take this with a little bit of caution in that in the enterprise platform, clearly SAP and Oracle primarily in that space, but Microsoft has a much broader portfolio which will drive up the number of deals taking place under there for companies that partake in their particular technologies. And the lack of interest reflected in the multiples, the revenue multiples, the median for last year is under 1 at 1.9 and a very normal 6.7 type EBITDA multiple. So yes, there is some demand, but premium pricing is not going to take place for companies in that sector. That's not to say that they can't be sold and very good prices realised. So I wouldn't want anyone not to try selling in that area. It's just making sure you focus on making sure you've got the right attributes. So picking up some of the deals there, again, it's the ones that get bought are the ones that got clear IP, something that their buyers can take and leverage and take off around the market. I think flying through those number of subgroups, the 5 subgroups we've put together, and looking at what their relative revenue and EBITDA multiples, I think it's this chart here and the size of the circle is indicative of the number of deals taking place. Cyber, big data are the places you ideally want to be. Cloud is strong as well in terms of volume, though the numbers not showing it having that higher revenue and EBITDA multiple, but I imagine that's more of a short-term issue and a point rather than a fundamental disadvantage in that particular sector. And the more traditional areas, ERP and outsourcing, the slackness of the deal multiples and the slackness of the volumes, the declining volumes is reflected in the sort of multiples that are being achieved, but those sort of companies can still be sold. So, conclusions, we think there's no slowdown. There is interest in the market, but particularly if you have big data analytics or some kind of cloud type attribute, then there is very serious demand, and there's no reason why, if you're a consulting business with those type of attributes, you shouldn't be looking to find a buyer for your businesses. So that's a very fast fly through some of the data. As I say, you can go and get our report off the net to get more details on it. But in the last few minutes, perhaps we may have a few questions if Paula wants to raise those to the forefront.
Thank you very much, Bruce, and thank you to those of you who have sent in questions. We'll try to answer as many as we possibly can. So the first question I've had in, Bruce, is what size does a company need to be before considering a sale?
Right, good question. In the UK, we talk about 5 and 1. So if you're 5 million sterling turnover and you are 1 million on the bottom line, then you hit people's purchasing requirements, and they can consider, even large buyers will consider companies of that size. Below that is trouble. It can be a trouble to justify a large buyer acquiring. To reflect across the US, I wouldn't just convert the dollar amount. Things tend to be a bit bigger in the US, so my sort of benchmark figures would be $10 million at the top and $2 million at the bottom. If you hit that, then you're good enough to sell. One other dynamic to look at, though, is growth and gross profit. So if you're growing at 20% and you're making 50% gross profit and at 20% on the bottom line, then you've got the dynamics. And if you've got the $10 million and £5 million, then you've got the fixed amount required to be attractive. You can sell outside those parameters, but if you've got those, then you are well set for a sale. Any others?
Thank you, Bruce. Yes, indeed. Is there any valuation difference for sector focus of the IT services business? For example, if they have a retail focus or a finance sector focus, etc.?
Good question. Focus is always a good thing. Focus is good for you selling your services because you go in and you talk the language. Now, I know a lot of IT products can be very cross-sector, and by definition you can then run around and sell them cross-sector. But generally speaking, the greater the level of sector focus, the greater the strength and value is perceived by the buyers. In addition, some buyers are very sector organized. So you take the Big Four or the likes of Accenture, they have a sector focus and they like to be able to slot a business into one of those sectors. And so if you've got that focus, that's better. What effect that has on multiples, I wouldn't like to say absolutely, but clearly there are sectors that are hot, like financial services, and there are sectors that are not hot, like raw material mining. And I think if you apply those sort of criteria and what's big in the GDP growth, and if you're playing in that space, then there will be greater demand. Perhaps just worth picking up that point is, well, I have been talking here about multiples. The most important thing when you're looking to sell your company and determine its value is you have to have something that people want. Value always follows that. Buyers don't look around at a certain price point. They look around for things they want, and then we try and work the price up to be as great as possible, and they're prepared to pay as much as they can get a return. So desire from the buyer group is the driver rather than any mathematical multiple calculation.
Thank you, Bruce. Another question that we've had is, our company has both consulting, about 60%, and a software offering at about 40%. So how would such a company be valued?
Valuation is always based on what you are worth to the buyer, and it's what profits you make and can help incrementally make working with them. A consulting business that has a related piece of software that supports that service will always be more valuable than a consulting company that doesn't have that related software. So that's always a good thing to have that, because it makes you a much more expandable platform for acquirer to get hold of. Now, if those two are unrelated, then that's going to be a challenge selling you if those two don't link together. But I don't think there is a fundamental different multiple being achieved for companies with consulting or with software. The software deals you do often see coming about with very high revenue multiples are a result of exceptionally strong revenue growth, and reflected in potential future profits that can be calculated. So I wouldn't seek to segregate a company in that situation. I would seek to ensure there's a unified offering that looks like it's got a scalable platform with certain long-term revenues, and the two together are very valuable, and more value will probably not be created by separating them, though that's a very generic comment, and I'd obviously welcome the opportunity to talk through the specifics in detail.
Thank you, Bruce. I think that's all we have time for now. If you posed a question which we didn't have time to answer, then we will get back to you after the event, and there are a couple I know that haven't yet been responded to, so we will get back to you. If you'd like to discuss the webinar or any aspect of your plans to sell, please do not hesitate to contact me. You can get me at paula.allerton@equiteq.com. And finally, if you aren't already a member, then please do join our Equiteq Edge Club. It's a free source of information for consulting firm owners looking to realise equity value in their businesses. You'll find expert guidance, unique research, guest articles, and lots more, including the newsletter. So thank you to Bruce for a very insightful presentation, and thank you to everyone for attending. A recording of this webinar will be available within 24 hours, and we will send you a link. Finally, if you have any questions or comments, please feel free to contact us. We'd love to hear from you. Thank you.